Good afternoon, everyone. Welcome to today's market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to look at the four major market indices: the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at them, we'll take a quick look at the US dollar. We'll look at oil, gold, silver, see how they're behaving, and then we'll move on to any chart requests that any viewers might have. So anyone in here, if you have something you want me to look at, feel free to type it into the chat tab. Or if you have any questions regarding any of my analysis, feel free to add it there as well. If you like what you see here, you like the way I analyze stocks using technical analysis, you can always follow me on Twitter at StockDarts. Find these videos at YouTube under StockDarts, or visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, as well as kind of expanding on whatever information we come across during these Wednesday market reviews. Typically what we do on Wednesdays is we try to get a gauge on what kind of market environment we're in and what kind of trades will be working during that type of environment. And what I end up doing then is just basically going on patreon.com and posting blog posts on trades that are going to try to take advantage of these strategies that we develop during these Wednesday market reviews. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. What we're going to do is look at the ETF SPY. We tend to look at these through the ETFs that are widely followed. And as you can see, it's not a good week. It's actually been a pretty bad week. This was something that I highlighted on my Monday post on Patreon, was that I was going to back off of swing trading this week. We have a lot of earnings coming up tomorrow, a lot of big earnings. We have basically most of the big FANG stocks reporting tomorrow. I'll show you really quickly. And with that kind of hanging over the market's head, with the fact that we were breaking below key support, I figured this is a week that I should probably focus on trading earnings rather than focused on swing trading, because directionally, the market's not in a spot right now that I'm very interested in. As you can see, tomorrow afternoon, we've got Amazon, Apple, Facebook, Activision and Twitter, Google. So you've got the big ones: Amazon, Apple, Facebook, and Google. Really, the only FANG stock missing from there is Netflix, which reported a little bit earlier. And we had Tesla that reported recently, which is not a FANG stock, but is another widely followed big tech stock that has been driving the market upwards. But as you can see, we've got a lot of big earnings that are kind of hanging over the head of the market right now. And that's going to have an impact on where the market wants to go in the near future. But this week, again, has been really poor. And so what led me to want to stay away from swing trading this week was this breakdown here. So this level on the S&P 500 on SPY, 343. That's kind of an important level. It's been important since back here in September 3rd. As you can see, this was when we first really started to pull back. We've been in kind of a corrective mode since the beginning of September. Before that, we were actually in a pretty nice market that was just kind of steadily climbing upwards and didn't really have any real selling pressure. We had one moment here back in June where we had a couple of weeks of trading sideways, but we found support pretty quickly and developed a nice little consolidation pattern, which led to this string of rising wedges, which we discussed during this time, how these rising wedges were making the market develop into a way in which we were likely to finally eventually have a kind of a quick correction, which we did have, right? And so that quick correction began on September 3rd, and that's when we started to drop, right? And so that level became important because on September 3rd, you can see it was the low, and on the following day it was the close. And for those of you that visit me on these Wednesdays, you know that we've gone over this before. But just to kind of recap, that became a critical level, right? It was support that turned into resistance. As you can see, it was pretty strong resistance over the following week and a half. And we finally made our way right back to that level, beginning of October, and we're able to break above it. And this was a really nice breakout that made it look like the market was ready to reach new highs, or test the recent highs at the very least. And that really didn't materialize. As a matter of fact, we kind of stalled out here on October 12th. And since then, we've been in a corrective mode. Now, it was a pretty normal consolidation up until the start of this week. And this week, this is where we had the big shift in character, where we broke down below that. And that was a big warning sign for me that maybe this is not a good time to trade directionally. You can look at shorting, right? When the market's in a situation like this, when you see this kind of a breakdown below what is an important level, you can start looking at shorts a little bit more. However, in the long run, we're still in a good market. Right? If you really think about where we are now, what we've done this year, where we were before the year started, where we are now, generally speaking, this is still a pretty strong bull market. And so I'm not that excited about shorts. I wouldn't necessarily criticize someone or say that, shorting is a bad idea right now. I don't know what happened there. Um, but generally, I'd rather stick to long plays until I see a bigger shift in the long-term chart of the market, right? So in the short term, you could look at shorts, but more what I'm interested in this market when it corrects is I'm interested in buying the dip. But with the way the action has been going this week, with all the earnings that are in tap, and remember, I just showed you a picture of some of the major names, but this is probably the busiest week, and so what ends up happening is I don't like to directionally trade during earnings season. If a stock has a report that's coming in the next week or a few days or maybe even 2 weeks, because it gives you a much smaller window of success because it has to be right before that time, because most earnings bring an extra level of volatility or uncertainty into a trade that you probably don't want to find. Generally, when you're trading, the number one rule is to kind of manage your risk and to make sure that you're protecting your capital. And earnings is usually a time when stocks are the most volatile because there's a lot of unknown news that kind of comes out overnight, and then all of a sudden that could lead to these big swings back and forth. Even a 5 or 6% drop, which isn't really a big thing in the bigger scheme of things, that could be a big drop for you if you had a relatively tight stop of 1 or 2%, and all of a sudden you're taking double the loss. And so, generally speaking, when I'm directionally swing trading, I tend to avoid trading stocks that are in earnings. Now, that doesn't mean I don't trade earnings stocks. Matter of fact, one of my favorite trading styles is trading earnings, but it's a different style altogether. It's not where I'm directionally swinging. It's where I use options in order to trade the implied volatility and try to either buy or sell premium depending on what my analysis is on that particular stock. And that's obviously subject for a different day. But just letting you know, you don't necessarily need to avoid earnings depending on what style of trade you have. But for someone that's just swing trading from day to day or week to week, you tend to want to avoid that. Now, if you're it's a long-term holding, well, of course you're going to have to hold through earnings because long-term typically means more than 3 months, which is a quarterly report. So that's a different case altogether. Although even in those situations, you might want to be able to manage your risk by using options as well. But long story short, I didn't like the start to this week, and I decided this is a week where I don't want to swing trade because I don't like the market and I'm not that interested in shorting. So what we do in these situations is, one, you go to a different avenue of trading, which, like for me, was going to be earnings trades, or two, you start to build a list of stocks that you like that you want to buy at a discount. And a lot of those names are probably the FANG stocks, which are going to report tomorrow. So my advice for you before we continue with our analysis of the market is, if you like Facebook, Amazon, Google, Apple, and you are either don't have any shares or you're underweighted long term or you want to swing trade them, keep an eye on what they do tomorrow afternoon, basically Friday morning, and identify key levels of support that you'd like to enter them if they get to the level that you like. Um, and build a list like that. And when you see the market finally gain some traction and start to bounce, those stocks should do well, and that should be a good spot for you to go ahead and start buying the dip. And you should be prepared for it now, rather than being in a panic and wondering why this market is dropping and what you can do. In the bigger scheme of things, the market hasn't, and we're going to get to that in a second, it hasn't really broken any major levels of support, and it hasn't done anything really to change our stance on what our market read is, which is basically a range-bound environment. And let's go ahead and move into that in a second and see what we're looking at here. So like I said, this week was an ugly move, right? We broke down a key level of 342. We broke the 50-pair moving average, and today's candle was an acceleration of that down move, and looks really ugly in the short term, right? If you just look at it like this is not pretty. However, we zoom out a bit and we take a look at where we've been since about May. You'll notice that we're basically range bound. We found a nice level here, and so the last time, as I mentioned earlier, the last time we had any kind of real healthy consolidation in the market was back here in June and July. And you can see what ended up happening was we flipped this level of resistance right around 320 into support as we started to break through it. And we came back, and you can see that was a key level of support during our recent correction that basically took place during September. And it looks like we're headed right back that way. And we've got the 200-day moving average kind of coming up above it. And so this is what we kind of discussed these last 3-4 weeks, was the idea that the market might be trading in a range-bound manner. And this was really critical, and this was really obvious during this time when the market was going back and forth. And I was mentioning the best thing we could do is employ range-bound strategies where we're looking to buy support and sell resistance because the market was not in the same state that it was earlier, where it was just basically going upwards and momentum was taking advantage, was kind of the key play and what we would try to take advantage of. In this case, you want to take advantage of a market that's going back and forth and finding support and hitting resistance and just playing the edges of the range back and forth. And in the bigger scheme of things, even after this breakout, we're still basically range bound. If you just take your little rectangle tool over here and you look at what the market's doing, you can see we're just trading in about a 40-point range from about 320 to just below 360. And that's kind of been the case if you really think about it. The bottom of that range was defined way back here when it was the top of the previous range, right? And you can look at it again, just take a look at it like that. And so, by the way, for those of you that maybe are new to technical analysis and have only learned, or maybe have really just decided, oh, it's just trend lines, you can, just the rectangle can help you identify ranges as well. And you just kind of look back and forth and you could figure out what these ranges are. Now, it looks like hocus pocus. People that don't believe in technical analysis are just going to say, well, you're just connecting dots on a chart. But what you have to understand is that these lines, these little boxes, they basically represent trader sentiment. This is not a picture necessarily of the S&P 500. This is a picture of what people think of the price of the S&P 500, whether it's an individual trader, whether it's an institution. Either way, it shows, when you have a rectangle like this, it shows that for the most part, the consensus is that 297, 296 is a good value, and the 320 level is not a good value. And then what ends up happening is when you have enough buyers or bulls or enough demand, whatever word you want to use, it shifts, and then that level that was previously considered overvalued is now considered a good value. And so you move forward, and then you realize what the next level that buyers consider to be a poor value, where there just are more sellers than buyers, which in this case has been the 358, 359, just anything just short of 360. And so that's how you develop these ranges. And then these trend lines, what they're telling you is short-term sentiment, whether it's bullish or bearish, and the longer the trend line, the longer the sentiment, the bigger time frame that you're measuring. And so in these particular cases, what you're looking at is a different clash. And obviously my trend lines, I have quite a few of them on there, but that's because every Wednesday I add a new trend line depending on what we're reading on the market. But this is basically why I use technical analysis, is because it's giving us a good idea of trader sentiment and market psychology. And so, as you can see, if you look at the bigger picture, we're just range bound. And until we lose this level at 320, my analysis is going to be the same. Now, if we lose 320, then we have a little bit of a different picture. I don't think it's still the end of our bull market, but considering we have elections coming up and all the earnings that are coming up, this could be a market that's in transition into a different state. So it warrants us to be a little bit more cautious here and be a little bit more safe as far as how we want to go ahead and approach trading in the next week or two. But I would not suggest that you panic and try to close out a bunch of trades. I think if you're really worried about the market, you can maybe take profits on a few names that have done really well, or you could put a couple market hedges in with puts. But until I see a big shift in character, I'm going to continue assuming the market is just range bound, and it's just waiting for all this to clear, the elections and all these earnings to kind of clear the way, whatever the next stimulus package is going to be, if it comes into play. And then from there, we can gauge where the market is and what it expected out of that news and what it's going to do in the near future. But for now, I'm expecting it to be range bound, which means this level here, 320, is in my mind a very, very critical support level that I do not expect us to breach in the next week or two. I think we need much worse news than that. If we go back and take a look, earlier this year, that was an important support level, and it became a really important resistance level that took us a little bit of time to break through. And once we broke through it, that was that transition that I mentioned earlier, which has led us to this market that's kind of up here. And you can look at this and say, well, this is starting to look a bit like a double top, and that is the case, but it's not a double top until it actually breaks down below 320. So that's why this 320 level, in my mind, is pretty important and is going to be a level that I will consider to be a pretty big line in the sand as far as defining the health of the market in the short to intermediate term. So that's kind of the level that we want to watch and we want to keep an eye on. and make sure that we don't breach. I think if we do breach it, we're going to have to reassess where we stand and what our thoughts are going to be as far as approaching the market trading-wise into the end of the year. Now, keep in mind, typically as we start to head closer to Thanksgiving and Christmas, the market tends to behave a little bit more nicely, a little bit more benign price action, and we tend to get these little Christmas rallies, or sometimes very big ones. Now, that's not always the case. You don't want to just buy because you expect it to happen. But there was always the case that we're going to go ahead and hit support here and maybe spend a week or two trying to really find enough buyers to kind of bounce. And then from there, that might be around the time where we start to head into the middle of November, at which point maybe the market wants to kind of lift off again and start exploring back towards the range. But for now, like I said, I expect this range to hold, and I expect 320 to probably be the bottom of that range. The top of the range is obviously going to be just below 360, but as you can see, we have these levels now that have developed, which are pretty important, which may come into play before we ever get there. So if we do find a bounce, whether it's today, whether it's tomorrow, maybe we don't even come all the way down to 320. Maybe today's candle is the beginning of an intermediate bounce. Well, if we do bounce now, I think that this level around 343 becomes the short-term level of resistance that is going to be very difficult to breach. We have this, again, short-term sentiment, which is bearish, which is, kind of following along this trend line, which is now going to become an important area for us to break through once we do finally bounce. So we've got a couple of levels here of potential resistance, which are going to kind of hang overhead over the price action, and is going to kind of force the market to bounce a little bit less than maybe traders are hoping for. So at this point, I would consider any bounce we get to be short-lived until we come down and establish clear support. And again, it doesn't have to be 320. It could be just above it, which would give us a little bit of a bullish trend on the downside. Or it could even be that we break below it a little bit and then come right back up. But the key idea here is that we need to see support established soon, at which point we could come up and start trying to challenge some of these levels. But for now, if you're looking to trade, this is probably a week to kind of either take off or trade lightly or day trade if you're not comfortable taking earnings trades or moving into other commodities like currency trades or Bitcoin or something like that. All right, so those are the key levels on the S&P 500. Now, a lot of what I just said about the S&P, that analysis is also going to stand for the NASDAQ and the Dow Jones. If you look at the NASDAQ and you look at the Qs, which is the ETF we follow for it, you can see the same basic scenario, right? We had this support resistance, which was basically developed on September 3rd, and we broke it on Monday to the downside, which again was not a good sign. And you can see we were really trying our best to kind of stabilize here at the 283 level on the Qs, and we couldn't break through that trend line or that bearish sentiment, and then we broke down, right? And then we lost the 50-day moving average today, and again, a pretty ugly candle if you look at it in the short term. Now, I don't know that support is quite as clearly defined on the NASDAQ as it is on the SPY. That's the one key difference between the charts. Is on the S&P 500, we can go all the way back and take a look at where the major support level is. But the NASDAQ has been so strong, relatively speaking. I'm going to go to the weekly chart for this. That red line, which was basically the support zone from January and February, it's way down here where we're not going to come close to. And so this is a sign. This is one of the ways that I kind of define the market, and why I say that it's still in a pretty good bull market is, the S&P 500 looks all right, but if you look at the Qs, we're so far above, and this has been the leader for the market this year, because a lot of these tech names have been insulated from this pattern that we've had where we have to work at home and shop from home and do all kinds of stuff with this shutdown. And a lot of tech names have benefited from it, so they've been kind of the leaders. But the Qs have been the leaders of the market for a while now, way beyond 2020, and so this is kind of the one index that really you want to see hold its bull trend. And as you can see, there's a lot of room to go to the downside before we really need to worry about our bull trend. Even our previous all-time highs that we printed in February, we're way above those. And so if you look at the NASDAQ in a longer-term time frame, and you try to identify where the key levels of support are, you can see that we have a lot of, I don't want to say insignificant, but not major levels of support. We've got, because we kind of stair-stepped upwards. And so if you look at these levels, these are going to be the key areas that we look at for support. And I would expect the NASDAQ to hold a little bit better than the S&P 500 when it comes to coming back to those levels. So the first level of support is going to be somewhere between 270 and about 265 or so, which is this little clump of price action from September. Um, and I probably expect that to hold from here to next Wednesday. I don't think that we breach that. If we do breach that, we're probably going to come all the way down to the 255 level. At that point, the 200-day moving average will be a little bit closer to price, and that should offer, again, a spot for buyers to step in and assume that there's going to be some support around that level. Um, this is going to swing a little bit more wildly tomorrow when we have those big tech names, and I think from there we'll get a better gauge as to where support really is on this chart, or maybe we find it here. For all we know, Apple and Amazon are going to report blowout earnings or guidance based off of what's coming in the holidays, and that might lead to a big bounce in the market. So we don't know at the moment, and that's part of the reason why it's hard to trade right now, is because there's a lot of uncertainty with potential news events coming in the very, very near future. And until we have that out of the way, the market is going to be in a state of elevated uncertainty. Now, other than that, there's really not much more we can say that's that different that we're seeing here. We've got our moving averages. We've got, and at the moment, the 50 and the 20 are above price action, which again shows in the short term we are struggling, but we're still well above the 200. And I think with the NASDAQ, again, it's been in such a strong trend that what we can assume here is that it's going to chop around a bit, and it's going to take a bit to stabilize rather than just top out. Now, again, it could be really bad news or it could be really good news, and that could make a difference on the chart. But assuming that most of these earnings events are non-events, we should chop around until the election, and then from there we'll see what the market decides it wants to do based off of whatever is going to happen with that. And that could make a big difference. And until then, I think, again, the key thing here is you want to be careful. You want to protect yourself. You want to protect your capital. And so you don't want to get too crazy. You don't want to get too crazy trying to take trades here. Fat Boys, I don't know if you're in here. I saw you just tweeted me. You tend to come to these things. We'll go over WYNN in a second when we cover the markets, and I'll explain what I did on that stock and how I managed that trade. And I'll respond to you later on Twitter if you're, for whatever reason, you're not here today. And so that's where we stand. And, it is what it is, right? It's uncertain right now. And like I said, we're in a market that's correcting, and I don't think it's found a bottom yet. So until it finds a bottom, we're probably better off kind of standing to the sideline and waiting for a market to find buyers. Now, we look at the Dow Jones. Similar story, but much weaker. And again, this is not a surprise because the Dow, relatively speaking, has been weaker all year. So here was Monday's price action. You can see the candle was worse than what we saw in the S&P 500 and the NASDAQ. And it's continued downward and has continued to behave poorly. And it's all the way down here to levels of support that the other indices haven't hit yet. You'll notice the red line, which identified support back in January and February. Well, that was basically resistance that we couldn't get above or hold above, depending on your take. And we've lost that same key level that was from September 3rd. We're all the way down here. We're looking at the 200-day moving average now as key support. So generally speaking, the NASDAQ and the S&P 500, while they're correcting, they're still at pretty major levels of support or above. And the Dow is actually at a much more important level of support that's a little bit more important long term. If you take a look at, and here's the action from basically 2018, and you can see again our rectangle, right? We had the market was range bound for a good year and a half, almost, well, basically 2 years, particularly on the Dow. And usually you don't want to go back into these ranges. Now, of course, we sliced completely through that range back in March with the whole coronavirus thing. And that was, these kind of black swan events are going to cut right through previous levels. When you have news that bad, technical analysis doesn't really make much of a difference, because you have the market is such an emotional state that it's not going to respect a lot of the boundaries from prior areas. But we eventually made our way back. And now we're trading in a much less emotionally charged time, so you expect these levels to hold a little bit better. And as you can see, and we'll extend this green line, which basically is in the same exact spot as the top of that range, right? And you can see that's right where we are right now. So we're actually at a pretty critical level on the Dow. which is the top of the previous range. And typically, resistance should flip to support and vice versa. And you would hope that this holds here because, again, the Dow has been weaker. It has been punished a little bit more severely this year with our response to the coronavirus because there are names that are more impacted on the Dow index than there are on say, the Qs, for instance. And so it's definitely struggled compared to, when you have components like Boeing or Caterpillar. They're going to struggle a little bit more when you have things like the airlines being shut down, or where you have just basically industries having to send people home because they can't work, unless they're from home, or they have to be quarantined. So you have a lot of different areas of our economy that have really struggled, and a lot of them are placed in the Dow, and so that has led it to be a little bit weaker. And as you can see, it's at an important price point. We've got the 200 just below it, and so this is going to be a key one because this could lead a breakdown. If it ends up being weaker, it should be the first one to break down to lower levels. So we have to watch this to see how it behaves. Again, tomorrow's a big day, and we'll see how maybe Apple can prop it up a bit and keep it from breaking below this range. But the rest of the analysis is the same. It's done the same thing as the S&P 500 and the NASDAQ, just relatively speaking in a weaker place or weaker areas. Other than that, it's basically doing the same thing. We needed to get back above this 282 range, and at the very least, we wanted to hold above where it is right now and not get past it. Other than that, it's not much more I want to add to it. I think, again, looking at the S&P 500 and the Qs gives us as good a read or a better read than the Dow at the moment. Now, the key index here is IWM, and I think IWM it's been an interesting thing here because it actually has been, relatively speaking, the strongest index over the last month. As you can see, on Monday and Tuesday, it actually didn't breach its recent support zone, and it wasn't until today's price action that it finally caved in and broke down. So again, this is leading us to believe that there's more downside in the market because the strongest index in the short term, it didn't hold and pull the others with it. The others eventually pulled it down, and so this leads me to believe that we still haven't found a bottom, and we're still looking for a bottom, and we're still looking to figure out where demand is and where buyers are going to finally come in and support the market again. And I don't know. I don't think that we found it yet. This candle, you might look at it and say, well, I mean, we found a little bit of support here, right where we started to break out, but I don't think this is enough yet. The candle's developing below the 50-pair moving average, which is not a good sign. It's kind of below this gap or into this gap. The only positive really is that it's above this breakout from this recent correction that we had in basically October and September, or August and September. And we'll see. We need to find support here. Again, relatively speaking, in the long term, IWM is still weak. It's just that in the short term, it's been picking up some steam. And I think again, the problem here is that the weaker indices have pulled it down rather than it being the stronger one that tried to hold the others with it. And so the fact that it broke down today is not that great of a sign and is a little bit concerning. A little bit concerning to me because it lost its key level and is now below key support. And again, one of the things, when you're trading, you identify these levels of support. When they break, that's a sign to just kind of stay away, right? Because this means that the stock is not in the right place, and there's more potential for bad news when a stock is on this side of your trend lines compared to the other side. And so at this point, it's not in a spot that I would trust very well, and is in a spot that I would, again, like I said, why I'm not trading this week very actively, because the market is not in a spot right now that it warrants any kind of trust for me. And until I see a change in character and I see a bottom develop, I'm going to stick to day trades and earnings trades that have very little correlation with the overall market. And I think that's the key right now, is where the market is right now. If you don't trade it, but you still need to trade or want to trade, say you trade for an income, or say you're someone that just actively trades a lot, when the market is in a place like this, you want to find trades that don't correlate with it. So, day trades where you're just looking for a 10-20 minute move or an hour move, or earnings trades that really have zero correlation with the market. Good news on an earning is going to override anything the market is doing, at least for that day or the next couple days, at the very least. So that's why I'm sticking to that kind of stuff and staying away from trades that are basically trading in the same direction as this market, because this is not somewhere, unless you're trying to short, this is not a good place. And I've already outlined why I'm not that interested in shorting at the moment, although I'm getting a little bit more lenient on that stance as we see what happens with the current market circumstances. All right, so that's the overall picture of the market and my stance and why I'm trading the way I'm trading. Let's take a quick look at the U.S. dollar. We'll look at oil, gold, silver, and then we'll look at any charts that you guys maybe want to look at. I'll go over that WYNN trade that I had. That was a trade from last week that did well for us last week, but of course has been caught up in what happened with the market. And I'll explain my thought process and how I traded that. But first, let's look at the UUP index. This is the dollars in aggregate. As you can see, a big gap up today, which is basically inversely correlated to what the market's doing. Generally, what the market, or what the U.S. dollar is doing right now, is just trying to bottom out. It's basically just trading sideways again. We could get our little rectangle tool, and we could identify exactly what kind of range we're in, and you can see it's basically just trading sideways. Now, yes, we have a little bit of attempted breakout that failed, a little breakdown that failed, but it's basically just trading in a range between about 25.30 and about 24.80 or so on the UUP index. Now, I don't normally trade this. I just use this as a gauge for the dollar as an aggregate. If you look at the individual currency crosses, for instance, this is the euro US dollar. Now, this chart is inverse of that other one because it's based off of the euro. So up is good for the euro, down is good for the US dollar. And so in this particular case, again, the euro, it's the same basic idea that instead of the US dollar bottoming, it's the euro kind of topping. And you can see this base forming, and it's the same exact range, and it's the same thing. We had that potential breakout on the dollar that failed, which was a breakdown on the euro that failed. And at the moment, they're just kind of trading in equilibrium, and we can't find a strong move in either direction to push it one way or the other. And so it's just range bound. This happens often when you have a strong move, is rather than it coming straight down, you know, we've gotten used to, or we anticipate a lot of these V type of bottoms and tops. But more often than not, what the market does is when you have a strong move, it just changes to neutral. And then eventually we'll either go back towards the previous direction or roll back in the other direction. And so at the moment, the market's still, you know, as far as the euro is concerned and the US dollar, it's still trying to figure out where it wants to go next. It's just trading sideways. If we look at the US versus the Canadian, it's the same thing. The US dollar is trying to establish a bottom. Nice move over the last couple of days. Oil has broken down, which is kind of leading a little bit to this, or vice versa. And what we have here is, again, the U.S. dollar trying to establish a foothold and trying to stop from going in the wrong direction. And again, it still has overhead resistance. I would still consider it to be in a neutral place. So anyone that actually took this as a long trade, you should be coming up to an area where you want to take some profits. Matter of fact, I'd probably take partial here and then just wait for 133.4 or so. As a spot to take the rest of the profit if you had taken a trade in that. And then finally, the last currency cross we want to look at is the US yen. And in this case, you can see the Japanese yen actually has been kind of strong, which has led to weakness in the US dollar versus it. It still isn't really fully bottomed out. You can see it's still struggling to find where support is. And has been the weakest. And so this shows that there's still some currency weakness in the U.S. dollar versus the others, but it's held up, particularly versus the euro. When you see Europe has had another, just like us, they've had a lot of problems containing the coronavirus recently, and you know, you look at France and how it's had to start shutting things down, and other countries as well, and that's led to the euro picking up a little bit of weakness, which has helped the U.S. dollar against it. But as you can see, versus the yen, you know, for whatever reason, is acting a little bit better versus the dollar over the very short term. And so what is that going to do when we look at the U.S. dollar behaving better? Bad news for gold and silver. And as you can see, we had another breakdown. And so gold and silver is still really just in a tough spot right now. We had this breakout, which was really promising, and then it failed. And this is important, by the way. Again, this is why you take these trend lines. Some people might have been like, well, I'm going to hold it because it's really still doing fine. But it was on the wrong side of that trend line. And what happens more often than not, when you're on the wrong side of a trend line, that's when you get these surprises. Now, this is not a major gap down. You know, you're only looking at about a 2-point gap down. But for someone that bought it here, looking for a breakout, and they didn't stop out as soon as it came down here. They've added to their losses now while they're waiting for this thing to break to go back in their direction. And there's always the chance that this continues to go down if the dollar indeed does bottom out and start to come up a little bit. So, I thought that this might have been a promising area, but it failed. And as you can see, this area has become a pretty decent resistance for GLD and for gold. And until it's back on that side, it's hard to trust. And it's going to be the same case with silver, which it's also really struggling to get back above a key level. And so, we had a pretty bullish move on gold and silver in August and September, and there's a decent chance that they will once again gain some bullish momentum in the future. But for the moment, they are not in a spot that's really that conducive to trading. I've kind of stayed away from them for a while now because I've had a hard time trusting their moves, and I'd like to see the price action quiet down a little bit more. And then from there, maybe they offer a better trade. But as you can see, with the gap down today, it looks like it wants to head down and test support again. And then finally, the last commodity we want to look at is oil. And as you can see, oil in the short term has dropped quite a bit over the last 5 or 6 days. Some of that is going to be mirrored in the U.S.-Canadian move, but it's back towards support. We identified this as a key zone for it in its short-term range. It's basically trading between 42 and about 36 or so, and it's getting pretty close to 36. So I'd expect oil to stabilize, and we'd probably find some support here in the near future, because I think oil has actually been in a pretty stable place for several months now, and I don't know that we've had enough shutdowns to warrant us worried about energy consumption dropping or energy demand dropping, which would lead to a drop below this 36 level. So I think for now this is probably safe. All right, so that covers it as far as oil, gold, silver, commodities, all that stuff. The last thing really I want to point out again is for those of you that are looking for somewhere to trade. I know not a lot of people like cryptocurrencies or trust cryptocurrencies, but Bitcoin has had a really big breakout. And if you're into this sort of thing, you probably want to be pretty, you want to probably pay a lot of attention to what's going on here. Not just with Bitcoin, but with all the other coins, because they're starting to pick up a little bit of momentum and a little bit of a bid. And while, today's move is not good, as it failed significantly as it tried to get above 14, it's still doing a pretty good move here as it starts to break out above, or broke above 12, and it's starting to make a bigger move. We look at on the weekly chart and we see where it is. You can see it's really starting to pick up some steam, and there is, we look at what it did when it really was on fire back in 2017, 2018. We're at a level right now which is pretty key resistance, but if it eventually breaks through that level, there's another 4,000, 5,000 points that we can get from here. And now, is it a buy right now? No. But, keep an eye on it if you're into this sort of thing, because it is picking up some steam, and it has been starting to behave pretty well in the near future, in the recent past. All right, so that covers it. Let's take a look at, again, I don't think Fat Boys is in here. He might be working, so he messaged me on Twitter. So I'm going to go over this, and he usually looks at the recordings of this thing. So for those that maybe don't know, Fat Boy's he's one of my Patreon supporters or members. He has a subscription, and he takes a lot of the trades that we take. And this was a trade we placed on Monday last week, and you can see what was. So Monday was the 19th. So this was a trade I highlighted on the 19th, right? So what we were looking at was for. So WYNN was in a consolidation range, and so the idea was, as soon as it could break out of this triangle, it'd be worth a long play, right? And so you can see it broke out the next day on Tuesday, which made for a decent entry here around 72.40, and it actually had a nice 2-day move for us. Now, once it reaches this level, this was our primary target, not our final target, but this is where you scale out of a portion of the trade, whether it be half or a quarter or 30% or whatever. And then the next target was going to be a bit higher. Now, it ultimately failed, and so what ended up happening was it kind of started dropping now. On Monday, I decided I'm done with this. I didn't like the action. Like I said, I didn't like what I saw Monday across the board. Um, and so when I saw that price action on Monday on the indices, and I see the same follow, I see WYNN doing the same move. I just decided to close my trade because I don't want to. I don't want to get to a point where I'm losing. So I just stopped out before it got to break even, somewhere around the highs. Basically, the highs of that day was right what I was looking for. I didn't want to see that filled. And once it was filled, it's like, right, I'm done with the trade. And this could lead to a situation where it eventually bounces and I miss out on the trade. But what it did in this case is it stopped me from losing more money, waiting for a move to come all the way back down to these levels. So this is important for you. Those of you that are maybe wondering my style of trading and how I like to trade. What I found helps me a lot emotionally as far as taking profits or waiting for a stock to move is when you first take a trade, you have a stop in place, right? So for me, this breakout around 72, at that point, the stop is really down here, right? But once it starts to come up and I take profits on the first part of my trade, I don't want to lose on that. So I'll move my stop to usually not necessarily my entry, but somewhere around there, whether it's just above it or just below it, to protect myself and make sure that this trade doesn't turn into a loser after it's already given me some profits. And then in this particular case, with the overall market, if the market was in a good state, so for instance, we're going to go back to the S&P 500 here. So if on Monday, if the market was holding above this green line, then I would have given WYNN a little bit more wiggle room. I wouldn't have necessarily closed it out because the market was still in a good place and was still flirting with a breakout. But when I see the market give me a clear signal that there's going to be further downside this week, well then that means that I'm going to be more aggressive with any of my stocks. And when I have a stock that's in one of these coin flip situations where it's all of a sudden not in the same place that I like it. So for instance, again, we're going to zoom in really close to this. So here's where we stood on Friday, right? And you have these two candles. I don't really want this to ever get back below 74. I want it to continue pushing back above 75. And so when on Monday we have this move down, if it's a strong market, I'll give it room. I'll keep my stop down here somewhere below my entry candle. But when I see a market that's breaking support and is showing me and broadcasting that there's further downside coming this week, well then there's no reason for me want to hold this longer. And so that's when I ended up closing it. Right here, right around 73, 10 or 12 or somewhere in that area. And then bam. Not happy with it now, and I'm even more upset with it if I was still holding it now when it's coming right back down below that. So, Fat Boys, if you're in here, you should have stopped out on this. If you haven't, you should be stopping out now. Now, could this bounce? Yes, it could definitely bounce, but there's always the chance that we get more downside and it continues to head lower. So, my advice in these situations is to make sure you respect your stops and not try to avoid. What happens is traders don't want to be wrong, so they don't want to take a loss on a trade. But the truth is that at this point it wasn't a loss; it was just a very small profit. And so that's kind of how I manage these trades. And just to show you guys, this was the type of trade I look at when we're in a range-bound market. Again, we're a stock at support. Consolidating, looking like it wants to bounce off of support, because typically support holds in a range-bound market. Now again, it's starting to fail because the market is showing signs of a different type of character, which is part of the reason why I didn't want to stay in it for much longer. Alright, so that's the answer for Fat Boys when you go and watch this recording. Those of you that are in here, if you have any questions on this style of trading or on how I manage this, or if you have another chart you want me to look at, feel free to ask away. Other than that, we could probably call it a wrap here. But I'd love to see if any of you guys have anything you want me to look at. Alright, if not, then I guess we could just call it a day. If you want to ask a question, but you didn't want to ask on here, or maybe you think of a question tomorrow, you can always ask me on Twitter. Twitter. Just follow me at StockDarts on Twitter, and I'd be more than happy to give you an answer on that platform if you need it, whether it's a DM or regular public tweet. Hope you guys have a good rest of this week. Enjoy your Halloween weekend, and we will meet again next Wednesday.